In this video, we're going to talk about how to manage risk during a flash crash. What's up, everybody? My name is Mickael. I'm the founder of ChartYourTrade.com, and our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And I believe that we can, and through this channel and through everything that ChartYourTrade does, we are giving you the tools, the mindset, the strategies, tactics, everything that you need in order to be successful at the stock market. Still with having a separate full-time job, you might have a family, you might have children, you might have so many other things going on in your life, and you can be successful in the stock market. And this channel and everything that ChartYourTrade does is meant to help you achieve that. So what do we do when the market has a flash crash of any kind? It starts with preparation. So let's talk a little bit about preparation. On this channel, I often talk about how to set up stop losses and to plan your trade well in advance before you even put on your trade. So always know where you're going to both get into a trade and where you're going to get out of a trade before you even place the order with your broker. And the places where you intend to get out should have some kind of a meaning on a stock chart. And so you will be able to find various levels of support and resistance, and we've spoken about this in other videos. You can go back and watch them. I'll link them somewhere down below and in the description. And once we identify the level of where we are going to get into the trade and where we're going to get out of the trade, that's solving the bulk of our problems already. What we also want to do when preparing and how we're managing risk along the way is to use bracketed stops. Now, well, what are bracketed stops? That means that you're not going to have a stop that's going to wipe out your entire position. It means that at different levels and different prices, you'll exit a certain portion of your position. And it could be any amount of your position. You might exit half of your position at one price and the other half of your position at another price. You might do it in thirds. You might have it be kind of like a pyramid where you exit 10% over here, you exit 30% over here, and you exit 60% down here. But the idea is that by having these staggered stop losses, these bracketed stop losses, you're able to scale out of the position, and if a stock starts to crash, then you'll start to get stopped out at different levels, and you could have a stop loss way down at what would be considered major support. So if you wanted to have a stop loss, if you have a position and you want to make sure that you hold on to this position unless if really all hell breaks loose and there's just, you're not willing to hold on to any bit of this trade anymore because it's just falling and falling and falling, you could set a stop loss way down here and have other stops up here along the way, so that way you're scaling out over here as it starts to break down, then down here, and then if it gets to that level where you just really think that this stock is done, then you could have another stop way down here and sell out. Now, when we're talking about mini flash crashes, the concern is that it's just a flash and the market's going to continue higher and you're going to be stopped out of the trade and you're going to see this stock just reverse on you. I get that. So that's the first part of why you want to have these bracketed stops. So that way, rather than just have your stop loss way down here at that level where you just want to be out of the position, you're scaling out along the way. So that way, if it does reverse, you're not selling everything down here at the bottom. You started to scale out a bit. And also, if it doesn't get to that level and you sold it here and here, then at least you've held on to something and you're in a better position to continue playing the position on that reversal. So let's talk a little bit about how to prepare for a reversal. Now, reversal in price simply means that the price falls down to a certain point and then it reverses higher on the day and it closes near the top of its range. This happens relatively frequently in the market, and the reversals that we want to try to buy are the ones where it's bouncing off of some kind of a major support level, whether that be a key moving average. And what a key moving average is going to be will vary from stock to stock. So some stocks will be supporting the 21-day exponential moving average, for example. Other stocks may completely ignore that moving average, and then the 50-day becomes more important. The 50-day moving average is the one that's typically looked at the most. The 50-day and really the 200-day. In between those, you also have the 100-day moving average, but you really want to, well, when you're looking at this stuff, you want to look at the chart, you want to plot all these different moving averages. It's real simple to do that. There's a trading service that I use called TradingView. I did a video on that as well, so it'll show you how to set all this stuff up, and you could literally set this up in like 2 minutes. But you would see these moving averages, see how price is behaving around them, and then when it goes down to that moving average and then reverses higher, that's the reversal. And so the way that you would play this reversal, especially if you own a stock and you have this mini flash crash and you end up getting shaken out, you want to see and plan out ahead of time where might you get shaken out, right? So that way it's not a huge shocker to you if it does happen, and you'll be of a much better mindset to take advantage of it because you've already kind of sketched this out in your head of what are the possibilities. So you see this possibility happen and it happens right there in front of you on the chart. Okay, so it reverses higher by the end of the day. Now, there's a couple of ways that you could do this. The first way is going to be to look at that area of support, and you could just buy as it's touching that level of support. That has some pluses, some minuses. The pluses are that you would potentially get in at the lowest price because you would see that it's testing this level of support and price just came and started to rally off of it, and then you could try to get in there, and then if it starts to fall back below that low, then you're out. This is what some people may refer to as catching a falling knife, but it really depends on the circumstance. Some people are able to take advantage of it and they have tremendous upside from there. Some people have great difficulty playing that kind of a move. It's really going to depend on what you and your circumstance, and if you're able to go for these kinds of intraday moves, if you're able to take advantage of something like that. You could set up alerts. There's a lot of different ways that you might be able to take advantage of that and not sit in front of a computer screen all day long. But it's all going to start with mindset. The second thing that you could do is check in at the end of the day. And this is something that I like to do as well. And I'm not somebody that sits in front of the computer all day. I have a separate full-time job. I have a lot of other obligations. I do not watch the market all day long. So this is something that works for me, and so I'll share it. The way that I like to do it is by looking at the price action at the end of the day. And if at the end of the day we have that big reversal off of support and it closes near the high of the day, then that's the first indication that it may have been the low that was put in down here. If volume accompanies that, so if you see that reversal happen and volume on the day is well above average and well above, say, the past several days, several weeks worth of volume, the higher the volume, the better, then that's a very strong indication that, yeah, that was the bottom and you could be working your way higher. So depending on where the low of the day is and where the high of the day ends up being, it could be a solid spot for you to start a position either on the short term, the intermediate term, or long term too, depending on how it is that you want to trade. And so you would enter at that high of the day or near the close, if it's closing near the top of the range, and then set your stop loss right below the low of that day. And you're basically just playing that high low, and with the probability that it can continue higher, and if it does roll over, then that's it. See you later. The third way that you could play this potential reversal would be to see if there is some kind of a descending trend line or some other kind of potential resistance level that the stock would need to get above, and then buy as it's bouncing and breaking above that short-term resistance. And so we like to call that, and Adam taught me this, that you're buying the bounce after the dip. So it dips hard and then it starts to consolidate and rally, and then when it finally does continue to break out above an advanced pivot point, then that right there is you buying the bounce after the dip. So there are a couple of examples that I want to go through with you. They were submitted, and this topic, by the way, was submitted by Mickael through YouTube. And if you have any kind of topics that you would like me to cover, by all means, just leave them down in the comments section below, and I will do it in a future video. So the examples that Mickael would like to see are YY, ATHM, and ANET. So let's take a look at each of those. Now here's a couple of charts with YY. First, on top, we're looking at the daily chart, and below that we have the weekly chart. So the first thing that pops out at me is that YY has been running for a very long time, and it's been running since April of 2017, and it's run about 170%, and pretty much all along the way, you see this red line here, that's the 10-week moving average. And really since April, it's done a very good job of holding and closing above that line all the way until we get to February of this year, 2018. And even that week, when it finally did close below the 10-week line, it reversed off of the low and closed in the middle of the trading range. So what does that correspond to? So that's February 5th, and over here, or the week of February 5th rather, and we see up here on the daily chart, let's make this daily chart a little bit bigger. You can see that it corresponds to that week and is reversing off of this light gray line over here, and what that line is, that's that 100-day moving average. So moving averages tend to be very important because there are institutions that do look at these things and look to buy off of these things, and many other traders use them, and so they end up becoming important levels of support, but it's also quantifying the move. So on more of a shorter term micro level, you could see as YY pulled back to the 50-day moving average over here, it did so kind of dramatically, right? Because if you're somebody that bought this and it quickly ran up about 30%, and then for it to pull all the way back off of that high towards the 50-day moving average, you quickly gave up about 20% in about a week and a half. That's difficult action if you are a shorter term trader. Now, if you are somebody that's much longer term, and let's say that you did buy way back here, then a move like that may not scare you as much. But over here, you start to see that it's climbing up, and here's where you get that little flash crash. Right? Well, he asked the question on January 30th, so I think that this might be the day that that we're referencing. So you get this gap down, and you're starting to test. Look at the low, right? Like, I always like to see what the low is and where support might begin to show up. The first spot is typically going to be the 50-day moving average if the shorter term moving average doesn't hold. So you have that purple line, that's the 21-day exponential moving average. It was holding it over here, starting to work its way higher, and as price starts to become more extended from these moving averages, and the longer that a stock remains above them, it becomes more likely, and the probability increases, that those moving averages will be tested and broken. And it doesn't mean that the trend is over, it just means that it's overdue, and we have to anticipate a little bit that a test might happen. And if a test does happen, where are some other levels that people might come in and start buying off of it? So there's the 50-day moving average. Kind of correlates to potential support right over here, or what was former resistance right around over here. So if we take our drawing tool and we draw a line over here, we could kind of see that there was a ceiling over there, and it was acting as a floor sort of for at least that one instance. But within the greater context, YY had gotten support at the 50-day moving average for a very long time. So it finally breaking below the 50-day moving average, it isn't that surprising, but it's also something that we need to be aware of as well, and also know what other levels of support there might be. So breaking below the 50-day moving average is one potential sell signal. Do we have to take all sell signals? No, we need to analyze and take things within the broader context of what's going on. And most importantly for us, well, we need to manage our own risk first, and how somebody that's trading this stock from way back here is going to be different than somebody that's trading this stock from up here. So we need to manage our risk first, and that's going to be an individual decision. But within the context of this move, it tests that 100-day moving average, and that sort of, on the chart, does it really look like there's anything else to the right, or to the left rather, of this chart? Not really. You know, let's see if we could take this and move it down. Is there anything down there? You might be able to make the argument that it's that level over there, or even if you wanted to move it down to this, now you're kind of like in no man's land a little bit. The 100-day moving average makes a lot of sense, because you're getting the shakeout below the 50-day, you're getting a little bit of a shakeout below this, or you're getting support at that over there. And it's not that much further, right? Like, if you wanted to test that 200-day moving average, then just from a break of the 50-day, you would have to sit through another 27-30% drop, and that's something that would be difficult for most people, unless if you are somebody that's really a buy and holder and intend to hold this for several years and not even look at it. So that's my thoughts on YY. Let's move on to the next one. Here is ATHM, and again, we're starting with both the weekly chart on the bottom and the daily chart on the top. It's always good to look at both, so that way you get a broader sense of the move. So here we can see that ATHM has been running for a very long time as well. Really, it started back here, back in 2016 as well, so November 2016, and just to measure this move, grab the ruler. It's run, it's not letting me go higher, but it's run roughly, I'd say about 180% if it let me get to the top of that chart. And you could see where it was starting to get support. So it started to break out down here, ran, then pulled back in, tested that 40-week line, that black line, and then from there got some support at the 10-week line, pulled back underneath it, didn't touch that 40-week line this time, and is rallying off of it. So for right now, it would look as though that 40-week line is more of the place where you would expect it to start to get support for a longer term trend. Taking a closer look at the daily chart, you can see the choppiness around the 50-day moving average. It breaks out, it comes in, it tests it. It's actually testing that 50-day moving average again. We'll see if that holds, and then as it's testing it a little bit more, it's starting to build a little bit more reliability around that. Today is going to be an important day for ATHM, and if it fails and it ends up coming back below that 50-day moving average, you could kind of see that you have that 100-day moving average right there, right by support. And what does that correlate to? Does it correlate to anything? Not much. Really just this move up here as it really broke out on super heavy volume and then started to test that level right there. So that's around the $70 level. So if the 50-day moving average fails, then the next level of support that I would look for would be right at around 70. But let's talk about that flash crash day, or that day that Mickael wrote in. It was January 30th, so that's this over here. So on a shorter term basis, if let's say you're somebody that got in right there as it was breaking out, and that's a pretty solid trade. So I don't know, Mickael, if this is a trade that you took, but if you did, kudos to you. Wanted to measure this. So this was about 18%, and you see that it was starting to tighten up over here, and you would really have something that's well, what's going on with this chart? Yeah, so from entry to exit on this, you would only be risking about 4.5%. That's really solid if you got into that. Breaks out above resistance and runs hard, and then ends up pulling back, right? So how far did it run? ATHM ran about 25% in only about 3 weeks. That's quite a hefty gain. And depending on how you're playing this and what kind of rules you're following, for example, in this book here, William O'Neill talks about an 8-week hold rule, where if a stock makes a gain of at least 20% or more after breaking out, and it's able to do that in 3 weeks or less, then he recommends holding that stock for at least 8 weeks. So that means that you could be sitting through some pretty hefty pullbacks, and if you're somebody that got into this and you're watching this kind of a pullback happen, right? So at least giving back about 20%, that's something that's not easy to sit with, and it's also not easy to see this kind of a move here where you're riding up this 5-day exponential moving average, right? That's that little sort of black line. I think that it's a black line. Maybe your eyes are better than mine, but breaks below that and kind of disregards that 10-day exponential moving average and goes straight down to the 21-day. Stocks can't go up and hold moving averages forever. They run up, they consolidate, and then they'll either continue their move, chop around sideways. They move in all different directions. And the 5-day exponential moving average in particular is not something that's going to be held for an extended period most of the time. The fact that it was even able to hold it between January 2nd and all the way through January 30th is something that is pretty remarkable and speaks to the strength of ATHM, at least during that time period. One of the things that I would recommend doing too, especially if you are more of a swing trader, this is the strategy that I would do for my swing trading, would be to scale out on the way up. And so the way that I do it would be to see how much I risked, and over here we risked about 4.5%. So as we got to multiples of the amount that I risked, right? So if we get to 2 times that risk, so at 9%, I would be taking a little bit off the table. Then at 18%, I'm taking a little bit more off the table. And then maybe I'm just starting to raise my stop up as I'm noticing this support along the 5-day exponential moving average, and I'm probably stopped out on this day for the remaining shares that I had, but that's okay because it was intended to be a swing trade. We always need to know what our time frame is because that's going to help us understand how to manage the trade. If I'm looking at this as a much longer term or intermediate term trade even, then you got to anticipate that it's going to have consolidations and that the 50-day moving average would be really the first spot where you would look to begin managing your risk. Even on this, you would probably end up moving your stop up to break even. And then after it tests the 50-day and reverses off of it, then now maybe you are raising your stop up to that level or just below that level. And now you have both the 50-day moving average, you have that level of support, and you have that 100-day moving average that would help hopefully keep you in the trade, and you'd still be locking in a little bit of a gain if it does break that level of support. Let's move on to our last stock. Now, the last stock that we're going to look at is Arista Networks, ticker symbol ANET. Now, the first thing that jumps out at me on this is, of course, this high volume reversal, outside reversal week. And what an outside reversal week means is that the price action is completely encumbering that of the prior week, right? So the high and the low completely encumber that of the prior week, and it's so that's the outside part, and it's a reversal onto its lows, right? So bearish outside reversal week, and it did that on the highest volume that it has had since it IPO'd way back in 2014. So that is about as big of a sell signal as you can get. That's a sign of major institutions unraveling their positions. And so does it mean that Arista Networks is done forever? No. But it does mean that, at least for now, you have major players that are unloading shares. And that there's evidence of that as you kind of see that the rebound is not happening on tremendous volume just yet. We can get a little bit more of a rebound from here, right? Like you do see that it came down to this 100-day moving average. It bounced off of that. Let's make this daily chart a little bit bigger so it's easier to see. So it did kind of get support off there for now. It rallied back above the 50-day moving average. It's back above all of its short-term moving averages as of today, but look at the volume. Like, the volume's not there that much, and so as institutions want to unload shares, they don't want to unload shares down here at this price. They want to unload shares at much better prices. So I wouldn't be surprised if we get to, say, I don't know, maybe the $280 level, and then start to see some additional selling around there, and this making a pretty short head and shoulders top. We'll see. We have to be prepared for anything. The main point, though, is that selling on volume like that is not something to be taken lightly. It's not a coincidence. It's major institutions, plural, selling at that kind of a volume. Again, you don't get that kind of a volume without it being multiple players unloading shares for whatever reason it might be. That happened to be right after earnings, and earnings weren't that bad if I recall. But to go back to the day that, that January 30th day that Mickael asked the question, that's this day over here. And that's a pretty gnarly day as well. And so how would you have prepared for that? Scaling out on the way up is one way. Having the bracketed stops is another. If you're somebody that bought this and you see it kind of riding its way up, maybe you're scaling out along the way. Maybe you see that it's getting support along that 5-day exponential moving average. You're tightening up your stops, and maybe your end of day, maybe you have bracketed stops like up here, somewhere in this neighborhood, and then somewhere down below here. So that way you have this level of support. The 50-day moving average isn't that far away. Maybe you have your support down, maybe your stop is down here, break even, and you allow for a test of that 50-day moving average, but your stops are staggered, right? So you don't want to be stopped out of your entire position way down here or down here. You want to be scaling out, so that way it gives you the opportunity to still be in that reversal if it does do something like this, where it probably stops you out of either part of your position or like 2/3 of your position, but you're still holding on to something, so that way when it does reverse higher, then you can make the call of, okay, do I want to still hold on or do I want to exit here? So that's my 2 cents on Arista Networks. Thank you all so much for watching. I truly, truly appreciate it. If you have any questions on anything I said at all, please leave it in the comment section below and I will personally help you. Also, if there's something that you want to see me do a topic on a future video, leave that in the comment section below as well, and I will do that topic in a future video. As always, click that thumbs up button if you like the video, and make sure that you subscribe to the channel so that way you get every single update. Thanks again for watching, and I'll see you again in the next video. Take care and have a great day.